Well, it looks like the single family residential home is taking its place as number one funding source for people. It looks like houses are now back to becoming ATMs. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate. Today is March the 10th. We're going to talk about mortgages and refis and a bit more. Today, once again, things are always happening in the real estate environment. But first of all, if you're not already a subscriber, if you could do me a great favor and smash that subscribe button, I would certainly appreciate that. Thank you very much. And today's video is brought to you by the friends at Foreclosure.com. Go to gethousingdata.com. Foreclosure.com is the nation's leading you could say provider of distressed property listings across the country. We talk about distressed properties. That's kind of our focus here on this site. So if you want to check out what's going on in your local market, go to gethousingdata.com. Real cool thing about our deal with Foreclosure.com is that we'll give you a 7-day free trial and you get great data for under $40 per month. So again, gethousingdata.com. Thanks. Now, to start this off, let's go back in time to the previous housing crisis. So many people associate the previous housing boom, bust, crash crisis with what we call the mortgage meltdown. So obviously, mortgages melted down, things went out of control, which caused foreclosures, people losing their homes, the whole bit, short sales, everything happened back, over a decade ago. But specifically, people think of the subprime mortgage crisis when you think of what happened in the last housing crisis or housing crash. Now, I put a little picture of The Big Short. Now, I can tell you one thing right now. Watch this movie. This is a great movie, and this puts things in perspective in kind of a tongue-in-cheek way with respect to what was going on in the last housing crisis. Yeah, there are certain things that maybe we don't talk about, like CDOs and stuff like that, because right now, it's not that important at this point in time. But you can see the evolution of what happened and how the mortgages sort of fell apart and where people ended up, and that's not a good thing. And we have a lot of history on that. So, but again, people always think subprime mortgage crisis or subprime mortgages were the issues that was all the problem back in the day. Well, it wasn't all of the problems. I can tell that the subprime mortgage crisis was the start of the problems. They were the first ones to fall. But overall, they didn't make up the majority of the loans that went bad back in the last housing crisis. That, I guess you could say, award or position was really to the Cash Out ReFi's. So, the subprime mortgage issues caused or started off the housing crash and crisis, but the Cash Out ReFi's were the bigger problem. That's why I want to talk about this today, because I was reading an article over on Wolf Street, and this was a few days ago. It was interesting because he's talking about how consumers paid down credit cards again by the most ever, but Cash Out ReFi spiked to the highest since 2005 and 2006 peaks, just before the last housing crisis. What gives? So, of course, this to me is problematic, because if I go back in time where I was, certainly participating in the last housing crash and crisis, we knew what was happening with the Cash Out ReFi. So really, people have been maybe taking their stimulus money, whatever their unemployment, whatever they're getting, and paying down high interest rate credit cards, which is cool. But in the opposite direction, the folks who own homes have been extracting cash from their homes via Cash Out refinancing mortgages at a clip in Q4 of 2020, not seen since the peak of the good old days before the housing bust in 2005 and 2006. And at record low mortgage rates while they lasted. But those two groups may not be the same people. So we've got, some people who are doing financially sound things, other people going, hey, I'm going to pull money out. So now listen, from a perspective though, if you've got a high credit card debt or high credit card interest rate, and you can pull cash out of your home by a Cash Out ReFi, and you're paying down higher interest rate credit cards with lower interest rate revolving credit on your house, that's probably a financially sound decision, because why pay 11, 12, 18% when you can pay 3%, 2.5%, whatever you're getting for your mortgage. So that's a positive thing. But realize though, when you take that Cash Out ReFi loan, obviously you've got your principal, so you're actually increasing your principal that you had because you're taking money out. So that's you got to realize that. Now, and what you're doing is now you're just restarting your mortgage. So if you were already in a 30-year mortgage for X number of years and you do a new Cash Out ReFi, that's great. But guess what? Most people are taking the 30-year payment plan. So you've now just extended your loan another 30 years. So if you're paying 5 years, 10 years before, when you refi, add another 30 years on. So it's taking that much longer to pay off your house. So people don't always consider that. They just consider money, etc. So what they're saying here is that historically low mortgage rates in the fourth quarter triggered a historic mortgage refi boom that exceeded the peaks before the housing bust. Amid this historic refi boom was a near historic cash out refi boom, according to the New York Fed report 2 weeks ago. The amount that homeowners extracted from their homes in Q4 spiked to $63 billion, which with borrowers on average extracting $27,000 from their homes. And I'll show you a chart in a second here. So that's a lot of stuff going on. Homeowners use the proceeds from cash out refis to fund consumption and investment opportunities, including home improvements, as the New York Fed said. So on one hand, consumers are paying down their expensive credit cards and other revolving credit. On the other hand, consumers are borrowing a lot more against their homes. So if you borrow a lot more against your homes, then you need to be feeling bullish that your home is going to retain that value or increase in value over time, right? So this is a chart that the New York Fed put out. You can take a look at, back in sort of, the pre-crisis days or crash days from the first time around, 2003. Almost $80 billion was taken out in that credit in that quarter. If you look at the 2005 and 6, we're probably in that mid 70s, and then you can see it dips below just to a little bit over 60 in around 2007 and 8. And then if we follow the trajectory here, we're seeing it go down, 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 down. Of course, that was during the housing crisis, so clearly lending was virtually cut off. Standards were increasing. And with property values decreasing, there wasn't much equity you could pull out. Well, now once we sort of turn the corner in the trough there, 2013 and 14 and 12, we can see some little spikes here and there, kind of plateaued a little bit around 2019, and then bang, the past couple years, little spike for 2019 to 20, and then a big spike from 20 to 21. So really, people are going, look at all this newfound equity and wealth. Let's pull money out here. So. But again, when you take a look at where this chart lies in Q4 2020, it's pretty much just as the last housing crisis was starting, everything was falling apart. So we're kind of almost back to where we were. And again, historically low interest rates. You've got an economy that's being stoked. You got a housing industry that's being controlled and manipulated. Low interest rates a whole bit. So this is a recipe for disaster. And as I mentioned, cash out refis were a big problem and one of the big culprits to the overall previous housing crash from back in the day. So please keep that in mind. So because his points are here that it's possible that some folks with cash out refis have also have credit card debt. They're using the proceeds from the cash out refis to pay down the credit card debt's great. Makes sense. But it is also possible that there's little overlap between these groups, between the people who've paid down their cards and those who increase their mortgage debt via cash out refis, because we don't know if that's what people are using the money for. All right. But I can tell you in the last housing crisis, when people were pulling money out, they weren't using it for home improvement. So you see a home equity line, a cash out or a cash out refi. Usually some of the reasons people say they're going to utilize is because, well, I'm pulling money out, we're going to put an addition on or put a pool in or a spa or redo the kitchen, whatever. So things that you're going to do that are money back in the house to increase the overall value of the house from a net perspective. Well, I can tell you that from what I saw last 10 years ago plus, they weren't doing that. They were buying cars, big screen TVs, going on trips, buying boats, all sorts of stuff. And in the end, all that stuff got repoed or taken back. Simple as that. So the point, though, here is that, so the theory is that most of the cash out refis used to pay down expensive credit cards doesn't hold water, is what he's saying. These are different consumers. As the New York Fed pointed out, the cash out refis are mostly used to fund consumption or home improvements, such as a new deck and hot tub, which has been backordered because of the surge in demand, or speculative investments in what they're seemingly forever booming financial markets. So, yeah, so even though the Fed's going to say, oh, it's for home improvement, well, consumption is very broad, and speculative investments is stock market, maybe buying other real estate. Who knows what you're doing with that money? So a lot of that money that's being taken out is not really being used for again, let's fix our property and it'll increase in value, etc. So this is problematic down the road for us. Suddenly rising mortgage rates to tango with the refi boom. So mortgage rates bottomed out early January and have risen since then. The average 30-year fixed mortgage rate, according to Freddie Mac's benchmark index, increased from 2.65 in early January to 3.02 on average during the first week of Wednesday. Since then, mortgage rates have further risen, which is not reflected in the data yet. So we all know that mortgage applications on a weekly basis, that's how they're reported these days. They go up and down based on the smallest of movements, and we've seen a couple of increases now in mortgage rates. So what in retrospect, what happens? We've seen a decrease in mortgage applications, both on the refi side and both on the purchase side. So that's what you're going to see now. 3% still good. I mean, 6 months ago, we were saying 3% is a great rate, or maybe a bit longer. So, it's not like we're talking 3% is a bad rate, but hey, to get into those mid six, the mid twos is really attractive. And I think people will wait to see if it moves a bit lower. But I do believe the Fed's kind of gone on record saying that, they're going to slowly start to move interest rates up. So this could be a trend that we'll see. So maybe the refi boom could be slowing down. We'll see if it has a bit of resurrection. If some rates drop a little bit, maybe last time around people can do this. But as I said, Q4 has we're back to those record numbers that we had back in the previous housing crisis. Mortgage rates remain ultra low by historical standards. Basically, but if the more mortgage rates rise, the harder it is to make cash out refis work. So while some consumers are creating a little extra room on their credit card for future consumption, other consumers will find cash out refis to fund consumption, and will find it more expensive and difficult to do so as time goes on. Now, it's all relative speaking. Like clearly, if we go up a few percentage points, overall, if we're going from 2.65 to 3 or 3.1, 3.2, yeah, maybe you can't take out as much. But if your property values have risen, it's still kind of consummate with, hey, you've kind of gained some equity, so to speak. So you can pull out with what a little bit, maybe a little bit less, but you can still do that for the time being. So this is the scoop, and for me, it's kind of like, when will this ride and this market cannot be sustained? The reason why I'm talking about the cash out refis is just it's one more thing that when housing analysts or housing, we call them the housing hype hacks, as opposed to the housing bubble bros or housing forbearance bros that I guess I am apparently in that category. But the point is that mortgages are good credit, tight lending standards. We're not going to have problems. Well, what do we have today? We have FHA being like the leading lender or the segment out there. And what is FHA known for? Low down payment, high debt to income ratio, which is actually lesser standards than conventional. If we're having these low interest rates, it's encouraging people to overbuy and overspend. If we're doing cash out refis with low rates, same thing. It's kind of like, when you're taking money out of your property at peak values, if you're doing an 80% loan to value and, you've taken money out, if you've got some fluctuation, they need to sell, you're kind of caught, right? You've taken money out, you can't pay that back, right? Sell your property, closing costs, commissions, cost of sales, prorations, curb appeal, whatever you've got to do to fix the place up, etc. So this is where people get caught. They keep thinking that the bubble's going to keep going up, and there's no end to it. So hey, if I break even next year, I'll be happy. No one, that's worst case scenario in a lot of people's minds. That's bubble theory. Nobody or very few people actually contemplate, what if it drops and I'm stuck holding the bag here? What am I going to do? And that's where problems will occur and rise. We have problems now. They're not manifesting themselves right now. They will occur as the next few months roll up. And this will, again, more fuel to the fire. So all these Q4 refinances, cash out refis, that might be problematic in a year or 2 years from now, depending on where the market plays out here. So as I always mention, I haven't done many videos lately just because I've got a lot on the go and some stress is happening in my life as well. But the whole point here is that, we're, the January numbers for, delinquencies and foreclosures, we're looking at, 3.3 million as per Black Knight. Every week we see mortgage forbearance ebbing and flowing, and it's down this week, whatever. Okay, I don't even believe the numbers anymore, quite frankly. I know the numbers are off, as I said, extrapolations, etc. So you got to keep that in mind, guys. As I said, it's not an accurate number. We get conflicting statistics. The actual number is much larger of who's not paying their mortgage, and there's just segments that we're not talking about. The mainstream media and all the analyst groups here that are pro-housing, they're just focusing on the forbearance people, and they're not really talking about who's having difficulty, who's not in forbearance, and how those numbers are increasing, and mom and pop landlords, other segments that don't even kind of get captured by some of the stats these guys are talking about right here. So as I mentioned before, the discussion on equity. Hey, equity is going to be great. Just you'll pay off your problems with your equity. Well, tell you what, if things change, that equity decreases. If you pull money out, your equity decreases. Market changes, equity decreases. The longer you don't pay your mortgage, if you have equity, your equity gets chipped away. So equity will not be the savior for the entire country. This is a very dangerous blanket statement that's designed to sort of get us to think, hey, no problems here. Don't look here. Don't worry about things. Everything's going to be all right, right? There's a song apparently called that, right? Anyway, just so you know, in the future, we're going to see lots of activity on the distress side, short sales, pre-foreclosure sales, foreclosure auctions, etc. 1% of all property sales right now fall into the distressed property category with REOs and short sales. No one's doing short sales. How do we know this? Look at the 1% rule. All right. This is the most recent data that was out for January from existing home data with respect to National Association of Realtors, so NAR. Look at the red arrow. That's the distressed sales. So the distressed sales across the country make up 1% or less of all the entire sales for that month. It's basically been that way for the entire year right now. So what that means is there's very little bank-owned being sold on the open market, and there's very little short sales going on the open market because there's specific reasons for that. But the point is it's all kind of bubbling and brewing and under pressure, like a volcano or a geyser. At some point in time, it's going to release and things will be a little bit crazy. So that's what we have to look forward to, though people will try to control the market. Foreclosure filings are quietly increasing. More properties are scheduled for foreclosure auction. Again, back to the 1% rule, people don't know what to do. They need our help to get them out of that jam. And also, let's make sure we're clear here. A foreclosure does not wipe out your debt. Okay, the foreclosure just is the vehicle where the lender can take your property back, or a third-party bidder can bid on it to get title and pay what's owed to, or what the lender accepts, off the sale price for your judgment. A foreclosure is a judgment. They can and will collect from you. A foreclosure doesn't wipe out all your debt. A short sale, on the other hand, is a settlement of debt. It's an agreement of all the parties. Has a lot more positive attributes than a foreclosure does. So for those of you who think foreclosure is the way to go to get rid of all your problems, it really isn't, and you should seek some counsel if that's what you're thinking. All right, guys. I have a new program called Zombie Foreclosure Flip. Funny how that's come out this time. I think it's important. It's not quite as intense as my short sale cash connection, but guess what? It talks to you about distressed properties and things like that. So check it out. Drop me a line if you want more information on this. And the reason being, it's because why will distressed properties and off-market properties be an important segment for the market? Because look, this is my MSA, the Tampa, St. Pete, Clearwater MSA down here. Where that red arrow sits, that's January statistics. You're looking at less than 1 month of inventory. That means there's virtually nothing in the retail sales force right now going on. What inventory means is that if no new properties came onto a local market, all the existing homes would be sold in less than a month. Analysts, and I guess it's almost like customary word of mouth, states that 6 months of inventory is a healthy and balanced market. So you've got markets who are 1 month, 2 months, less than 1 month all across the U.S. So it's not a healthy market for many reasons, which we'll talk about in future videos. And when we talk about the differences in distressed property, now obviously the sample size is small for the REOs and short sales because there's just not much going on out there. You can take a look in the area. Traditional sales, the median sales price is $285,000. The REO sales was $180,000, and the short sale median was $194,500. So right away, you're looking at significant equity and discounts over median sales price. And I can tell you that most of these sales are, I'm going to call them retail REOs or retail short sales, where I can almost guarantee that there wasn't much pushback or negotiation or positioning of the properties to get better price points for the buyer. So our system, what I do is a little differently. I drive it down. I have certain ways of doing things, and we typically can get better discounts than what you can see. But this is just retail. This is quick retail discounts. Looks pretty good. We can do better than that. And this is where a lot of the opportunity is going to lie, like it did in the last housing crisis. All right, guys. So having said that, if you want more information, you please give me a shout. I'm looking for financial partners for fix and flip projects in Florida. Great returns on investment is secured by the property, because if we can get properties at that discount and then we can fix and flip them and sell them at retail or higher, because of where the market's going, there is a significant opportunity there. So that's the whole point of real estate and real estate investing, is you're looking to buy low and as economic as possible, and you can sell the premium. So as much as, we as buyers are maybe tired and fed up with the marketplace being very expensive and low inventory, well, where there's an issue, there's always a way to work around it and succeed, which is what we're trying to do right here. Okay, so I'll tell you about it. Just connect with me, Randy@LuxuryShortSales.com. So once again, appreciate the views, the likes, the comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. And once again, reach out to me, because we got lots going on down here in our market, a lot of potential, a lot of cool things, and I'll talk to you about them if you reach out to me. All right, take care, guys. We'll look forward to speaking with you in a couple days.